What just happened with the Bank of England? And what does it mean for gold and silver? Hey everyone, thanks so much for watching Yankee Stacking. Lior Gantz is going to join me today to discuss the surprising central bank policy pivot by the Bank of England. Guys, quantitative easing is back in the UK. Their battle over inflation appears to be done. Is that what's coming here to the United States? Is our Fed's hawkishness going to end? And if so, will that shoot gold and silver prices way up? So please don't forget to hit the little thumbs up button right down there. That really helps the algorithm a lot. And let's hear what Lior has to say to us gold and silver stackers. Hi, Lior. Welcome back.
Thank you for having me back.
Great to see you again. Let's get right into it. The Bank of England. The central bank, decided to actually pivot the other day back to quantitative easing. They're purchasing long dated bonds in an attempt to avert an imminent crash.
Yeah.
They went back.
Why? Basically, when you look at bonds, if I was a pension fund and I, for the last 2 years, have kept the same mindset as I had in the last 10 years, that if I buy a bond, interest rates usually go down because central banks are monetizing it. And so the price of the bond goes up. I'm in a 38-year bull market in bonds. So I'm going to buy bonds. I'm a pension fund. I'm buying bonds. If I lend the British government $100,000 or 100,000 pounds, and there's a 1% coupon on that, I'm making $1,000 of income. Now, think about this. If the interest rates go up from 1% to 2%, to generate that same $1,000 worth of income, how much do I need to lend the government at 2%? Only $50,000. In other words, the guy who bought, the pension fund manager who bought or who lent the government money at $100,000 is sitting on a coupon that I can now get the same income lending half. So if you want to sell it to me, fine, sell it to me for $50,000 and lose $50,000, lose half on 1%. So think if interest rates go up a lot. It's exactly what's happening with mortgage payments, right? In the United States, if I wanted to buy a house and pay $300 in monthly payment a year ago, and if I wanted the same thing today, I have to buy a house that's half the size, okay, or thereabouts. That's what's happening right now, and it got to a point where the credit froze, the overnight lending froze, and that is usually how central bank planning works. What does Jay Powell tell you? He wants inflation to come down by how? He's going to tame the housing market. He's going to cause some unemployment. But what's happening usually is they make this A to B to C to D plan, but the market breaks way before that because it doesn't work that way. It happened in 2018. It happened every time. The pivot, though, is where I really want people to understand. What England did is not the model for the United States.
Well,
we're not going to go back.
Let me just jump in on first England, right? So Isn't it true that those pension fund managers gorged themselves on debt as well because of the low interest rates? That was not the right thing to do, and now they're paying for it.
Correct.
And so I know, Lior, you and I tend to agree on a lot of things. We agree that the Fed, other central banks, need to keep raising interest rates, that is the right thing to do. That is the healthy thing to do for any economy. You believe the Federal Reserve will not pause and, in fact, cannot reverse course, can't cut rates, can't go back to QE. And I think, unfortunately, that's exactly what they will eventually do. Do you still think the Fed will not pause and or pivot?
I think that when the Fed pivots, what it basically is going to do, it's going to stop raising interest rates, and it's going to say, look, with interest rates, we've exhausted our options. We don't need to keep raising, because raising more will just crater this into a very deep recession. We don't want that. And what we'll do is just continue to shrink our balance sheet. We will accelerate the pace at which we sell bonds and mortgage-backed securities. So they will actually accelerate QT in terms of selling and tightening basically their balance sheet. They will stop raising rates, and the markets will continue to expect a full pivot. I don't think that the markets are going to get a full pivot.
So we'll get a soft landing, especially in the bond market.
We're already in a hard landing. The plane is crashing.
Okay.
Like it's just look.
Well, some of them are still holding out hope. I mean, I think it was who was it? Raphael Bostic. I think he's the president of the Atlanta Fed. He still thinks, he's still dreaming of a soft landing.
Listen, the Fed doesn't care that shares of Facebook are down 70% this year. It doesn't care that shares of PayPal are down 80% or whatever. What the Fed cares about and where the Fed pivots is on either credit freeze, major unemployment problems, or a housing crash. That's what they really care about, because that impacts everyone. It doesn't impact just your retirement account.
They want broad impact. They want everybody to feel this.
Systemic impact. Something where they get a call from Washington. That's what makes them change their tune. We're not there. We have very low unemployment in this country. Fine, housing is not where it used to be a year ago, but man, was it unsustainable a year ago? We're not crashing yet.
Right.
We're definitely in a. They've done a lot wrong, a lot, and it's because they messed up on getting things right in early 2021. Instead of saying transitory, they just should have handled this very delicately and started raising rates when everyone was seeing that lumber prices are, things like lumber. This is not rocket science. This is lumber.
I just heard, I think it was this past Tuesday, I think it was on MSNBC Squawk Box, but it was Charles Evans. He's the president of the Chicago Fed. He implied that he's concerned that the Fed has raised rates too much, too quickly. I think it's like too little, too late. But does that comment from Evans strike you as maybe a potential crack in the dam with rates, Lior?
For sure. It's not just him. It's something you need to think about. Like, listen, let's say you make a mistake, okay? Let's take an analogy, okay? Let's say you're running after a train and it's already started to leave, okay? And you have to get on that train. Are you going to do anything to get on that train? Are you going to chase that train, jump on the roof, do whatever? If you already made a mistake, it doesn't mean you need to double down and make another huge mistake. There's other options. There's the bus. There's a taxi. There's other things available. There's the next train. You can call off you can do a lot of things. You can get the guy to come to you. I mean, look, the Fed, what it's done is unhealthy. It's just not healthy to get interest rates to how they've raised mortgage rates from, what was like 3% to 7% in 6 months. Are you kidding me? That's like the worst thing that can happen. The problem that the Fed is facing is that the public won't budge. The public is still very much employed. People have not lost their incomes. Sure, some people that bought in the last 6 months are upside down on their houses, but for the other 70 million home acquirers of the last decade, they're well in the money and they're fine. And they were locked in at fixed 30-year mortgages. This spike doesn't even bother them. And what I'm trying to tell you is this will take way longer than most people expect in order for this to really impact. And I don't think that they'll get to that point. I think that the markets will break before unemployment starts to become a crisis, before real estate starts to become a crisis. And therefore, I think that the Fed will start to acknowledge that and pivot, which is basically, hey, we're stopping the rate hikes. We will continue to reduce the balance sheet, and the end of zero interest rate policies, which is the report you and I co-authored at wealthresearchgroup.com/Yankee. That's what I think we're getting into in this business cycle. So when you ask me what I think, hey, won't they ever pivot? They will pivot. But in this business cycle between now and 2027, this business cycle that we're in, interest rates in America will stay at 3 to 5%. And they may do a little hikes there, or a little tightening, or a little, getting dovish, hawkish, etc. It's going to stay around that 4%. We're not going back to zero interest rates. Take that to the bank and actually go to wealth360.com/Yankee and realize what's behind us, because it's done. The idea of the Fed is to telegraph as much as they can without taking action. And I'll give you the perfect example. The market bottomed in April 2020 when the Fed said that they will start buying junk bonds of the Wilshire 5000. The markets went into a rally, and it ended with new all-time highs in August. How many junk bonds do you think they had to buy? The answer is zero. They didn't buy a single junk bond. They telegraphed.
All they had to do was threaten to do it. Yep.
Correct.
Right.
And when they say that they're resolute about inflation, they're basically trying to change your behavior without them actually doing the Paul Volcker thing. They're going to crack when it becomes political, when it's going to hurt people's jobs, and when it's going to hurt real estate. We are literally in a reset environment, very different from a classical recession. It's different. And right now the trend in Wall Street and everywhere else is the Fed is creating deflation. It's going to win. So everyone's selling their stock portfolios, everyone's selling down, cashing up. But the real trend, once we get to that breaking point, they will see they have not fixed inflation. Inflation will not be fixed. You will see the dollar index go from these crazy all-time highs of 113 on the DXY. You'll see them go down to 75 by the end of this cycle. We're going to see a 30 to 40% decline in real purchasing power of the dollar. And there's no reason not to see gold trading above 3,000 but in this cycle between now and 2027. There's no reason why silver cannot be over 50 and into the 60s within this cycle at a 50-to-1 ratio to gold. To me, gold, physical gold, is what I need for 2 years worth of my living expenses. So if my family unit spends $5,000 a month, in theory, you take $5,000 times 24, that's $120,000. You convert that fiat currency savings into physical gold. I'm done. I don't need more than that. The next time I'm going to evaluate that is either if my lifestyle is going up, so 5,000 goes to 6 times 24, it's 144. I need a few more ounces. Or if it becomes way less than 5% of my net worth. So those are my two measurements. If I'm already there, I don't need to be buying. I just won't sell during this panic. That's all I'm going to do. Now, if I want to, because I never sell, right? You never sell those gold ounces.
I don't either.
Okay. Okay. Now on the flip side, if you're looking and saying, hey, this is a generational dip, then gold is not interested to me. Only silver is interesting to me. Because if it's a generational dip, especially because of a very strong dollar, silver would way outperform gold. It's easier for me to think that if gold is going from 1,600 to 3,000, then or a 100% move, then silver is doing 20 to 60, which is 200%. So to me, it's easier to envision that after a big capitulation, silver will outperform gold. Who knows the next time we're going to get something like this?
Well, thanks so much for the insights, Lior. This was really fascinating, and I look forward to talking with you again soon.
Thank you, sir.